Welcome to ETF Leaders, powered by the New York Stock Exchange. Joining me today is Matt Camuso. Matt is the ETF Strategist at BNY Mellon Investment Management. Matt, great to see you. Thanks for joining me.
Great to be here. Thanks for having me.
All right, so Matt, tell me, how can your investment philosophy / active management help investors to navigate the market volatility?
Yeah, so I think a good example of this is our Concentrated International Equity ETF, which is ticker BKCI. So BKCI is sub-advised by Walter Scott, which is an investment specialist firm at BNY Mellon Investment Management. And what Walter Scott does to help clients navigate market volatility is really focus on a rigorous stock selection process. So what they try and focus on are companies that are high in quality, but also have a history of investment growth over different market cycles. Really what they try and look at is audited financials going back at least 10 years to see how companies navigated different market environments. So it's this combination of looking at companies with strong balance sheets, but also companies that have attractive growth prospects that are driven by different growth vectors, that they're not tied to certain cyclical growth periods, so that you help navigate over a full market cycle and take down volatility in the overall portfolio. BKCI, the ETF I mentioned, we only launched 5 months ago, so we don't have too much data to show for it right now. But if you look at other strategies that Walter Scott has managed, going back 20 years, they've actually exhibited much less drawdown capture as well as much less volatility than their benchmark, and they employ the same process with BKCI.
All right, so tell me, what are you hearing from institutions, advisors, retail right now?
What are we hearing? Certainly a lot to talk about, but if I had to summarize, I think all of our clients are trying to see what does the next decade look like relative to the previous decade. Obviously, the previous decade was dominated by easy monetary policy, which was a rising tide for really all asset classes. And if we fast forward to today, last month we had the Fed have a rate hike in May that was the largest in 22 years. So as clients are looking at a completely different environment and a much more hawkish Fed that we see for the foreseeable future, they're looking for more active solutions to complement their index or broad-based beta exposures in every asset class, so that the active manager can help them navigate this new market environment. So luckily we've launched now 6 active ETFs at BNY Mellon to help our clients along that journey, and they're certainly asking for it now that we're trying to just really uncover all of the uncertainty that's going on in markets.
All right, and finally, Matt, what guidance would you provide investors considering the rising rates?
Diversification is king. So diversification is always important, but especially when there's this much uncertainty. I think the volatility in the bond market is telling us that investors are trying to figure out, have we priced in enough Fed rate hikes? Do we need more? Is there less? So as we have that uncertainty and the market right now is so fluid, we need to make sure we're diversifying duration, so complementing ultra short type exposures with longer duration types exposures, but as well as from an asset class perspective. So looking at government bonds, investment grade corporate bonds, but as well as high yield. I think high yields, it's had a tough start to the year. Year-to-date outflows have been pretty significant, which is normal, I think, for a risk-off market environment.
And that's ETF Leaders, powered by the New York Stock Exchange.
Our PM team that runs our ETF BKHY, our high yield ETF, has actually put out an interesting piece of research earlier this year looking at high yield and rising rate environments. And actually, if you look back to 2004, which is the earliest we had comprehensive data for, the broad benchmark that we track with our ETF, which is the Bloomberg US Corporate High Yield Index, is over those 2004 to 2021, you have 7 periods of rising rates, and that index actually produced positive total returns in each of those 7 periods. Interestingly, in that case study, the rate component and the spread component were inversely correlated. So when the rate component detracted from performance, your spread component actually compensated for that detraction of performance from rates and then some, to again give you positive total return in each of those 7 rate hikes that we saw. I think if you look at that backdrop, now that's in history, we can't guarantee that's going to be going forward, but if you look at the macro environment right now, it's a very healthy economy, unemployment's low, wage growth is continuing to increase, the consumer's healthy, which kind of indicates default rates should remain low. You can get a nice income component from your high yield allocation and also help diversify your broader fixed income bucket.